On a typical morning in New York City, before most Americans finish their first cup of coffee, the lights inside Wall Street offices are already glowing. Screens flicker with charts, numbers move by the second, and billions of dollars shift hands in silence. From the outside, it looks chaotic. But inside those rooms, decisions are not made randomly. They are calculated, measured, and built on patterns developed over decades. And right now, despite the fear you see in headlines, many of those professionals are making one bold bet. They believe the bull market isn't over yet. To the average investor watching financial news, this belief might sound confusing. After all, the past few years have been filled with warnings. Inflation reached levels not seen in decades. Interest rates climbed faster than most people expected. Some economists warned that a recession was inevitable. For many everyday investors, this created fear. The kind of fear that makes people hesitate, sell too early, or avoid investing altogether. But while fear spread across headlines, something different was happening quietly behind the scenes. Step 1 in understanding Wall Street's confidence begins with corporate earnings, the heartbeat of the market. Imagine the stock market like a giant scoreboard. Each quarter, companies report their results, and those numbers reveal whether businesses are growing or shrinking. Over the past year, something surprising happened. Instead of collapsing under pressure, many U.S. companies reported stronger profits than expected. Technology companies found ways to cut costs and improve efficiency. Retail companies adapted to changing consumer habits. Even traditional industries adjusted their strategies to survive higher borrowing costs. For Wall Street, these earnings reports were not just numbers. They were proof that businesses were stronger than headlines suggested. Step 2 revolves around innovation, particularly artificial intelligence. In many ways, Wall Street sees AI as the next major economic revolution. Think back to the early days of the internet, when many people doubted its long-term impact. Today, it's impossible to imagine life without it. Investors believe artificial intelligence could follow a similar path. Companies are investing billions into automation tools, machine learning systems, and advanced computing technology. These tools are already reducing costs, improving efficiency, and creating entirely new industries. From healthcare systems diagnosing diseases faster to financial firms detecting fraud instantly, AI is becoming deeply integrated into the modern economy. Wall Street doesn't just see technology, it sees opportunity, productivity, and long-term growth. Step 3 focuses on the strength of the American consumer. The U.S. economy runs on spending. Every time someone buys groceries, books a flight, or upgrades a phone, that money flows into businesses across the country. Despite higher interest rates, Americans have continued to spend. Shopping centers remain active. Travel demand has remained strong. Restaurants continue serving customers. This ongoing activity tells investors something important. The economy hasn't stopped moving. Even when inflation pressures household budgets, consumer behavior has remained surprisingly resilient. That resilience acts like fuel for businesses, keeping revenues alive and supporting market stability. Step 4 looks at interest rates, one of the most powerful forces shaping markets. Over the past few years, the Federal Reserve increased interest rates to slow inflation. These moves made loans more expensive and forced businesses to rethink their spending. Initially, investors feared that aggressive rate hikes would crush growth completely, but now many analysts believe the most intense phase of rate increases may be behind us. Markets don't just react to what rates are today, they react to where rates might go tomorrow. If investors sense that rate hikes are slowing, confidence often returns. Historically, markets have performed well when interest rate cycles stabilize. That possibility alone keeps Wall Street cautiously optimistic. Step 5 explores a concept that many new investors don't fully understand: market psychology. There is an old saying among professional investors that bull markets climb a wall of worry. It sounds strange at first, but the idea is simple. When people are worried, many stay out of the market. They hold cash, wait for better conditions, and delay investment decisions. But when fear eventually fades, that sideline money returns. And when large amounts of money flow back into stocks, prices rise. Today, the market is surrounded by worries: inflation concerns, global tensions, election uncertainty, and economic slowdowns. Yet paradoxically, this environment of caution often supports the continuation of a bull market rather than ending it. Step 6 takes us deeper into corporate strategy. Over the past decade, many large U.S. companies strengthened their balance sheets. They reduced unnecessary debt, stored more cash reserves, and diversified their operations. These decisions were not made overnight. They were lessons learned from past crises, financial crashes, recessions, and unexpected global events. Because of this preparation, today's corporations are more flexible than before. When costs rise, they adjust quickly. When demand shifts, they innovate. This ability to adapt makes them more resistant to economic shocks, giving investors additional confidence in the market's stability. Step 7 highlights the role of long-term thinking. One major difference between professional investors and everyday investors is time horizon. Retail investors often worry about what happens tomorrow. Wall Street, however, focuses on what happens 5 or 10 years from now. They ask broader questions. How will technology reshape industries? How will global supply chains evolve? What industries will dominate the next decade? These long-term questions help investors stay calm during short-term turbulence. When markets dip temporarily, professionals often see opportunity rather than danger. Another factor supporting Wall Street's confidence is America's long-standing culture of innovation. The United States has repeatedly created industries that reshape the world, from automobiles to computers to the internet. Today, that tradition continues through artificial intelligence, renewable energy, biotechnology, and digital infrastructure. Investors believe this innovative momentum gives the U.S. economy a structural advantage. Even when older industries slow down, new ones rise to replace them. This cycle of innovation creates fresh opportunities and supports long-term economic growth. However, it's important to understand that confidence does not mean certainty. Wall Street does not ignore risks. Investors constantly monitor inflation data, employment trends, corporate earnings, and geopolitical developments. They prepare for volatility and maintain strategies designed to handle uncertainty. Markets will always experience setbacks, temporary declines, unexpected events, and moments of panic. These fluctuations are not signs of failure, but natural phases within longer growth cycles. For everyday investors watching from home, the real lesson lies in perspective. Headlines are designed to capture attention, often focusing on dramatic predictions and worst-case scenarios. But long-term investing requires looking beyond daily noise. It requires understanding the forces shaping the market beneath the surface: earnings growth, technological innovation, consumer behavior, and monetary policy. When viewed together, these forces create a broader picture that is often more optimistic than headlines suggest. As this market cycle continues, several signals will determine its direction. Corporate earnings will reveal whether businesses remain profitable. Inflation reports will indicate whether price pressures are stabilizing. Federal Reserve decisions will shape borrowing costs across the economy. And technological breakthroughs will continue influencing productivity and growth. These signals act like road signs, guiding investors through uncertain terrain. In the end, the reason Wall Street still believes the bull market isn't over comes down to a simple but powerful combination: resilient businesses, continuous innovation, strong consumer activity, and the possibility of stabilizing interest rates. None of these factors guarantee success, but together they form a foundation that supports cautious optimism. The story of this bull market is still unfolding. It may face challenges, corrections, and unexpected turns, but history shows that markets often reward patience, discipline, and long-term thinking. For investors willing to look beyond fear and focus on fundamentals, the future may hold opportunities that today's headlines fail to capture. And now, the real question is not just whether the bull market will continue, but whether investors are prepared to recognize the signals that shape its path forward.